At first glance, you might read the recent statement from the Fed and think, same old, same old. However, if you read between the lines, I think you might find some real insight into what their thinking is. We'll unpack more on the Fed and take a look at the overall state of the economy with my guest, Dr. David Kelly, JP Morgan Chief Global Strategist, right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks so much for joining us today, and taking a seat in the room with me today is Dr. David Kelly from JP Morgan. David, great to have you join us.
Glad to be here.
Lot to unpack. We just had the Fed meeting. Powell had his press conference. I just want to get your thoughts. There was a lot there, and again, as I said, it seemed like the statement wasn't very different, but the data seems to be changing. His kind of measured tone, very kind of cautious in the way he answered questions, seemed to indicate maybe he's thinking something else. What were your thoughts?
Well, I think what happened here is before the meeting, one of the interesting things that Chairman Powell does is he actually canvasses all 19 members of the Federal Open Market Committee and sort of has pre-games it with them in terms of what they're thinking. And I imagine that as he was doing that in recent days, before we got the CPI report, the story was, well, we're not going to cut in June. We might cut once in December, we might cut in September, but it's a close call. And frankly, the inflation story still looks a little on the hot side. And so I think that was how they went into the meeting. And so then they all submit their projections. And it turns out the way they submitted their projections, they didn't really change their view on economic growth. They're sort of right where they were. And by the way, where we think the economy is going to be. They nudged up their numbers on unemployment a bit, but just by a tenth.
Right.
And they're kind of right there. But they still have inflation that's going to take all the way until 2026, in their view, to get down to their magical 2%. Now, you might ask, why is it so important that we're at 2% as opposed to 2.6%? I don't know. I don't think it's that important. But they think it's important. So they all submitted their forecasts. And then what happened yesterday morning is that we got a CPI report, and that's important. And so the staff of the Federal Reserve actually then briefed the members of the Federal Open Market Committee on what just happened and what it might mean for the PCE deflator, and it takes it down by 1 decimal point in their forecast, I believe, and certainly in our own forecasts. So, instead of looking at a 2.6 at the end of the year, maybe it's a 2.5 at the end of the year. So that's what happened. But then he did what he always does, is where he says, okay, now does anybody want to change their forecast that you submitted? Now, if you're in that situation, you've been sitting in a meeting for the last day.
That's right.
And now you've got another meeting coming on, you've got a plane to catch and so forth. So are we going to change our forecast? No, we'll just leave the forecasts the way they are. And so they left the forecasts the way they are, but the way they are meant that we went from a projection in March of 3 rate cuts this year to a projection of just 1 rate cut this year. Now, admittedly, it's a close call. If 2 of those 19 members decide to change their vote by one dot, you'd end up with two rate cuts. So it's a very close call as to whether 1 in September, 1 in December, or just December. But what happened is there was just enough inertia there that they didn't change what they said. But I think when listening to his press conference, it's almost like he felt just a touch bit guilty about that, because maybe what they did was a little on the conservative side, a little bit on the hawkish side, given the data, which really do show that inflation is gradually coming down. It's just coming down slowly.
That's right. Even the producer price index number came out lower than expected. And so I think that is another indication that perhaps we're moving in the right direction.
Well, that's right. And if you dig beneath the numbers, that's what gives us some confidence in inflation is coming down, because we know what the problem is. The problem isn't core goods. The problem isn't in energy. It's not food. It's not that the economy is growing too fast or consumer spending is too booming. The problem is that there are 2 areas, shelter and auto insurance, which combined account for 2.5% of the 3.3% inflation rate year over year, just those 2 categories. And we know they're slow-moving, miscalculated, but pretty high right now, but they're going to come down. And they're seeing the same thing, we're seeing the same thing, but their attitude, I think, is, well, if it's not coming down that fast and the economy's fine, we'll just wait a bit.
Right.
And so they're just waiting.
Right. Even as we looked at the dot plot that we saw after the statement was released, as you mentioned, we went from perhaps 3 cuts this year to 1, but now they're saying perhaps 4 in 2025, which seems a little aggressive considering we went from 3 to 1 just yesterday.
Well, really, what they did is what I think happened was last time they had only 3 rate cuts in 2025, which is actually rather odd, because I think the pattern they're going to get into is they meet 8 times a year, but 4 times a year they put out forecasts, and those are the meetings where they're most likely to cut. So it makes sense to cut, in March, June, September, December. But for some reason last time around they had 3 rate cuts this year, then 3 rate cuts next year, which meant they were going to skip a meeting next year for some reason. Now they've said got rid of that anomaly, so they're down to 4 rate cuts. They're up to 4 rate cuts next year, but just 1 rate cut this year. So in the end, it's 25 basis points higher at the end of next year. It doesn't really mean that much. And I still don't think September's off the table. We just need a little bit more good inflation numbers, and suddenly one of those dots is going to move, or 2 of those dots are going to move, and we're back to September and December.
That's right. Interestingly, we had the European Central Bank and the Bank of Canada cutting rates at their recent meetings. Do you think that, I don't know if it would give Powell any pressure, but he has to be looking at what they're looking at and thinking, perhaps, are we moving in the right direction here?
I think this is a very close call. I don't think it has much of an impact on them. I think they have different stories in Canada and Europe. In Europe, the story is, look, inflation has a 2-handle, but also their growth is very slow. They're still tight labour markets, but they're not growing that quickly. So I think Christine Lagarde had reason to cut rates there. The Bank of Canada, the problem is they've got a housing issue, and they use a lot of adjustable rate mortgages, and there are a lot of people getting tremendously squeezed by high interest rates in Canada. And they also have inflation which starts with CPI inflation, which starts with a 2. Now our CPI inflation rate is 3.3%, so that's caused Canada and Europe to move a little ahead of us. But if they cut again, say in September, if the Europeans do, they'll have a meeting 1 week before we do. It might put a little pressure on the Federal Reserve, or it certainly gives them an excuse for saying, well, we're cutting, but look at everybody else, they're cutting too. So I do think that it slightly increases the odds of a rate cut in September.
What do you make of all the jobs data? Except for the payroll number recently, which came in much higher than expected at 272. JOLTS job openings fell, ADP employment fell, so it almost seems like we're moving in the right direction on the job front as well. Obviously, that's a major indicator for the Fed.
Yeah, it is, and I think we sort of approach it much the way the Federal Reserve does, which is, I look at it in terms of mosaic. All of these indicators, they're all imperfect, but together they build a picture. So with the household survey, which gives you the unemployment rate, and the payroll survey said very different things. According to the household survey, we added 376,000 jobs over the last year. According to the payroll survey, we added 2.8 million jobs. One of those surveys is wrong. In fact, both of them are probably wrong. I think the payroll survey is overestimating and the household survey is underestimating. But you look at other things. There's a conference board survey on, are jobs plentiful or hard to get? People say they're plentiful. The unemployment claims numbers are running in the low 220s. That's very tight. The ISM numbers in employment, they're looking pretty strong. So overall, I'd say it's still a strong, tight labour market, and that's what the mosaic is telling us, but also one which doesn't seem to cause a lot of inflation. The big difference, I think the thing the Fed has got wrong here is that they thought that with the labour market this tight, wages would accelerate. But frankly, while American consumers don't know when to not spend, American workers seem to be, for some reason, unable to ask for a raise. They don't, you can ask for a raise, guys. It's okay. They can't find, you're not replaceable. Yeah, but maybe they'll fire me. And so people don't ask for a raise. And that is helping. There are other things too. But what's happening is that wage growth is still very calm here. And that's really something the Federal Reserve didn't expect.
I'm afraid your email inbox is probably going to get flooded by the time you get back to your desk, David. Everybody asking for raises today. But
just what I need.
That's right, exactly. In the midst of all the other things that you've got going on. Within the markets themselves, obviously there's opportunities out there right now for investors. Where do you see the most, or given the environment that we're in, and of course looking at the way equity markets and treasuries have been trading and functioning, where's the best opportunity right now?
I think it's both a time of opportunity and a time of some danger. There are opportunities, I'll get to that in a moment, but what's happening is you've got this very stable, soft landing economy, which is just moving forward, inflation slowly coming down, interest rate, long-term rates, relatively normal levels. But what's happening is when you've got a normal economy, no shock, everybody's putting a little bit more money on the table day after day, and that's pushing that equity market up to all-time highs, and particularly for the mega cap stocks, you're looking at PE ratios of 30 times forward earnings, and it's a problem. And I worry that this, we're seeing not so much a feeling of euphoria, but just speculation in those prices. So I think people have got to be very careful about the concentration risk in the S&P and the concentration risk actually within just US equities. And so be careful about that. Make sure you're diversified. I'm not saying that international equities are going to beat US equities in the short run or that other areas are going to beat the mega caps in the short run, but recognize risk is growing. And returns are very loud. Risk is very quiet, but it grows. Where there are opportunities, I think there are opportunities in a lot of, within public markets. I think non-US equities, European equities, Japanese equities look pretty good. I think emerging market equities outside of China look good. China's a little bit more of a speculative play. But also in private markets. I mean, one of the things that's happened in the last decade or two is that public markets are sort of shrinking because of Sarbanes-Oxley, because of Dodd-Frank. You've got more space for private equity. You've got more space for private credit in the land between banks and bonds. There's just more space there. And so there are more opportunities there. I think you have to be very careful because there's less information, and you have to choose managers wisely. But in places like transportation, infrastructure, private credit, private equity, there are opportunities, and I think people ought to make sure they take advantage of those too.
Last question for you, David, before I let you go. If you look from 30,000 feet, and we're looking at everything we just talked about today, is the U.S. economy on strong footing, solid footing, medium footing? What's your take right now?
I think the U.S. economy is actually very strong and has really proven to be exceptional in our ability to keep this soft landing going, and exceptional in our ability to bring inflation down, even as that happens. But there are other opportunities out there. So I think the U.S. economy is still strong, but again, be diversified. It's not because of what you expect. It's because of stuff you don't expect.
That's right.
And that's really why people just have to be careful. People talk about risks. It's not just the risks out there. It's the risks that you're building in your own portfolio. Make sure you're balanced.
Great advice. David, thank you very much. Always good to see you. Thanks for coming by.
Anytime.
David Kelly from JP Morgan Asset Management. And thank you all for watching. For more information from JP Morgan Asset Management and, of course, some of our other great partners, visit our website at ubs.com/views, plus all the CIO content from UBS is right there as well. And make sure to follow us on our newly relaunched UBS Trending Instagram channel. Great content there for you. Give us a follow at UBS Trending. And as always, if you have any questions about what David and I spoke today, make sure you're reaching out to your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone, and remember to keep your eyes on what's trending. See you soon.